In March 2009, the world believed wealth was disappearing. The stock market had collapsed, banks were failing, millions of people watched their retirement accounts lose half their value in a matter of months. Families who had spent decades building financial security suddenly faced uncertainty they had never experienced before. Fear wasn't just in the markets, it was everywhere. It was in conversations, in news headlines, and in the quiet decisions people made late at night when they wondered what would happen next. In moments like that, people don't think about opportunity, they think about safety. They sell their investments, they move their money into cash, they choose certainty over uncertainty. And it feels like the right decision, because uncertainty is uncomfortable. It triggers something deep in the human mind, something designed for survival, not wealth creation. But something remarkable happened after that moment. While millions of people stepped away from the market, a smaller group of ordinary individuals stayed invested. They weren't experts, they didn't have special information, they weren't wealthy insiders or financial professionals. They simply stayed. And over the next decade, their wealth didn't just recover, it multiplied. Not because they were smarter, not because they predicted the future, but because they understood something most people didn't. Wealth is not built during moments of certainty. Wealth is built during moments of uncertainty. From the lowest point in 2009, the stock market began a recovery that would eventually become one of the longest and most powerful growth periods in modern history. The S&P 500 didn't just recover, it grew more than 6 times in value. This created millions of new millionaires. Not overnight, not through luck, but through consistency. People who invested regularly through retirement accounts, index funds, and long-term portfolios quietly built wealth in the background while the world focused on short-term fears. This pattern is not unique to 2009. It has happened repeatedly throughout history. After the Great Depression, markets eventually recovered and reached new highs. After the inflation crisis of the 1970s, markets recovered and grew. After the dot-com crash in 2000, markets recovered and grew again. After the global financial crisis in 2008, markets recovered. After the COVID crash in 2020, markets recovered faster than almost anyone expected. This pattern reveals something important. Wealth is not created in moments of confidence, it is created in moments of doubt. Because doubt creates hesitation, and hesitation creates opportunity. When people hesitate, they delay participation. When they delay participation, assets remain undervalued. And when assets remain undervalued, those who continue participating position themselves for long-term growth. This is how wealth is built quietly over time, not through dramatic decisions, but through consistent behavior. And right now, the world is entering another one of those rare periods where long-term wealth creation opportunities are quietly forming. But this time, it's driven by something even larger than a market cycle. It's driven by a generational shift. Over the next 2 decades, approximately $124 trillion will transfer from older generations to younger generations. This is known as the Great Wealth Transfer. It is the largest transfer of wealth in human history. To understand how massive this is, consider that the entire annual economic output of the United States is around $27 trillion. This transfer represents multiple times that amount. This wealth exists in many forms. It exists in retirement accounts, investment portfolios, real estate, businesses, and financial assets accumulated over decades. The baby boomer generation, born between 1946 and 1964, accumulated unprecedented levels of wealth due to decades of economic expansion, rising asset values, and long-term investment growth. Now that wealth is beginning to move. It will move to families, to heirs, and most importantly, back into the financial system. Because wealth rarely stays idle. It gets invested. It gets reinvested. It flows into markets, it flows into businesses, it flows into innovation. This movement of capital is one of the most powerful forces behind economic growth. When capital enters markets, it increases demand for assets. When demand increases, asset values tend to rise over time. This process benefits participants, not just those receiving inheritance, but those who remain invested in the system. This is one of the most misunderstood aspects of wealth creation. Many people believe wealth is built through individual effort alone, but in reality, wealth is also built by participating in systems that grow over time. Markets grow because businesses grow. Businesses grow because innovation continues. Innovation continues because human progress continues, and those who own productive assets participate in that growth. This is why long-term investing has historically been one of the most reliable ways to build wealth, not because markets never decline, but because markets recover and expand over time. One of the most powerful forces behind this growth is compounding. Compounding is the process where returns generate additional returns over time. It transforms time into a multiplier of growth. For example, investing consistently over decades allows small contributions to grow into significant amounts. This growth doesn't happen linearly, it accelerates. In the early years, progress may seem slow, but over time, growth becomes more noticeable. Eventually, growth becomes substantial. This is why time is one of the most valuable assets in wealth creation, because time allows compounding to work. Consistency allows compounding to continue, and patience allows compounding to reach its full potential. The greatest obstacle to this process is not lack of opportunity, it is human psychology. Fear causes people to exit markets during downturns. Excitement causes people to enter markets during peaks. This behavior interrupts compounding. It prevents long-term growth. It replaces strategy with reaction. But those who remain consistent avoid this cycle. They understand that volatility is normal. They understand that uncertainty is temporary. They focus on long-term participation rather than short-term prediction. Because predicting short-term movements is extremely difficult, but participating in long-term growth is achievable. Over long periods, markets reflect economic expansion, technological progress, and productivity improvements. This is why markets have historically trended upward over time, despite periods of volatility. The great wealth transfer will accelerate this process. As trillions of dollars move through the financial system, they will support continued investment, innovation, and growth. This creates opportunity not just for those receiving wealth, but for those who remain invested. Because wealth creation is not limited to those who inherit wealth. It is available to those who participate consistently in growing systems. This is the difference between observing wealth creation and participating in it. Many people observe wealth creation from a distance. They watch markets rise. They hear stories of financial success, but they remain outside the system. Others participate consistently. They allow time and growth to work in their favor. Over years and decades, this participation creates significant differences in financial outcomes. This difference is not created by intelligence alone. It is created by behavior, specifically the decision to remain consistent, the decision to remain patient, the decision to participate in long-term growth. 20 years from now, people will look back at this period. Some will realize they lived through one of the largest wealth-building periods in history. Others will realize they participated in it. The difference will not be luck. It will not be perfect timing. It will be consistent participation. Because wealth does not reward hesitation. It rewards participation. It rewards patience. It rewards consistency. The greatest wealth opportunities rarely appear obvious in the moment. They appear uncertain. They appear uncomfortable. They appear ordinary until enough time passes for their impact to become clear. And by then, those who participated early benefit the most. The great wealth transfer is not a single event.
It is a process that will unfold gradually over decades, a process driven by capital movement, investment, and growth. Those who understand this process position themselves differently. They focus on consistency. They focus on long-term participation. They focus on allowing time to work in their favor. Because wealth creation is not about predicting the future. It is about participating in growth over time. If you want to understand how wealth is really built and how to position yourself for the future, subscribe to Know Vision. This channel exists to help you understand the patterns, psychology, and systems behind wealth creation so you can see opportunities most people never notice. Your future is shaped by the decisions you make today.